So why do mortgage rates not drop immediately following a Fed rate cut? Well, here is where most people get tripped up. The federal funds rate and mortgage rates are not the same thing. The Fed controls short-term rates, things like credit cards, car loans, and home equity lines of credit, whereas mortgage rates, on the other hand, are determined by the bond market, specifically the yield on the 10-year Treasury note, which reflects long-term inflation expectations of the economy moving forward, and overall investor sentiment. So even though the Fed cut by a quarter point, mortgage interest rates didn't really see an effect as the bond market had already priced this in. In fact, right after the announcement, mortgage rates stayed relatively flat, hovering in the low to mid sixes in most cases for a primary residence, of course, differing depending on the loan type and the property type. Think of it this way, the Fed sets the tone, but the market decides the melody. Now, while investors are currently anticipating another rate cut coming in December, Jerome Powell's comments at this meeting were essentially to pump the brakes a bit. He stated a further reduction in the policy rate at the December meeting is not a foregone conclusion, in fact, far from it. That tells us that the Fed is staying flexible. They want to see more evidence that inflation is moving sustainably lower before they commit to a series of cuts. He also said, "We think policy is still modestly restrictive. That's one of the reasons you see a gradually cooling labor market, so that should help get inflation down." So what this means is that even after the cut, borrowing conditions are still tight enough to slow the economy and reduce price pressures. And Powell reinforced their main priority: we are absolutely committed to returning inflation to 2%. You'll see, that's where we're going. So while some people think this is the start of a big pivot, Powell's message is not yet. They're trying to balance patience with progress. So let's talk about the backdrop that the Fed is trying to navigate. Unemployment is still historically low in the mid 4% range, but it's up from earlier this year, signaling fewer job openings and slower hiring. Inflation, meanwhile, has crept back up a bit, sitting somewhere between 3 and 3.5% depending on the measure. That's well above the Fed's 2% goal. This is the classic tug-of-war moment. Inflation's not defeated, but growth is clearly cooling. Powell even said there were strongly different views among Fed members, some wanting a bigger cut, some wanting no cut at all. That division shows how uncertain things are right now.